joining us is Peter Lewis. He's head of Asian equities and derivatives at MF Global. Peter, also MF Global Hong Kong chief executive. Well, what do you make of it all? And what's the key driver? Is it just fear?
Well, this is what global contagion looks like. Synchronous declines in equity markets around the world, surges in safe haven currencies such as the yen, the Australian dollar. We've got surging gold, declines in industrial commodities. This is macroeconomic issues now, and it's a fear that maybe the US is going to enter another leg down in the recession, and it's fears about the global economy. And this is the typical transmission mechanism from one market to other markets around the world. So Asia is not particularly exposed to the political problems.
Nothing has changed since Friday, really, when it comes to the global economy, apart from that move by Standard & Poor's.
Well, I think there is a fear that maybe, particularly in the US, the situation is worse than we first thought. And if you look at those revisions to some of the economic data that we saw a few days ago, what it tells us is that the recession that we saw in the US in 2008 was far worse than anyone thought. The climb out of that recession has been much weaker than anyone thought. And people talk about Japan's 2 lost decades. Well, actually, America is now 6 years into its first lost decade. If you look at GDP on an inflation-adjusted basis, GDP per person is exactly where it was in the second quarter of 2005 in the US.
Okay, well, you know, what you fear most is perhaps sometimes what you get. This is the problem. We were talking with our resident economist about this becoming a self-fulfilling prophecy. Confidence weakens as a result of this fear factor, and that means people spend less, and then we get the whole thing feeding into itself.
Yep, and that is really where confidence becomes so important. And we saw this after the Lehman sort of crisis. We saw a collapse in confidence. As a result, people stopped spending, companies invested less. That caused a slowdown in global demand and the recession. And that was exactly the mechanism by which Asian economies were affected. And this is the reason why we're seeing economies such as China, South Korea, Taiwan being very badly affected, or markets being very badly affected today. They are exporting countries which depend upon a strong global economy.
Yeah, economists are locally, Bloomberg economists here, we're talking about what does the Fed do? Does the Fed do anything before the US Open just to calm things down?
Well, I suppose the obvious thing is that people will start talking about another round of quantitative easing.
They have been all morning.
Personally, I hope not, because all we saw QE2 do was create a huge global commodities bubble. And each time we do this, it has less and less effect. QE1 meant QE2 was less effective. The fact that we bailed out Greece means that it's much harder to bail out other European countries. So the cumulative effect of these gets less all the time.
Are we entering the capitulation phase in all this? And if we are, how long does it last for, and how much further down do we have to go?
Well, I think there is further down to go, because I think what investors want to see is signs that policymakers are using tools to try and solve what in effect is macroeconomic problems, and also politicians have the will and the ability to be able to do it. So we need to see some signs of moving away from the dysfunctional politics that we've been seeing in Europe and the US. It's always possible in markets like this to get very, very sharp rebounds, but at the moment I'm not seeing a lot of signs of investors really ploughing back into the markets. And if anything, there is still plenty more selling that could go on yet.
Right, Ben Bernanke, has he got any tools left? I mean, surely he's exhausted them. We've got zero rates, we've had bank bailouts, we've had ring fencing of bank assets, we've had QE1, QE2, and we've also, of course, now looking at the possibility of QE3. Now, surely the Einstein definition of madness is if you try the same thing over and over again with the hope of a different result. That is the definition of madness. So I had a guest on earlier, Todd Martin, saying that it's not going to be QE3 just like the others. It will be tied to a growth for jobs package.
Well, I think the key that's underpinning all of this is debt. And the issue is, how do we safely deleverage without causing a global recession? There is just too much debt around in the world, and we've seen that debt being parcelled up and passed along. So we've seen individuals pass along their debt to banks, who in turn have passed it on to governments, who in turn have passed it on to super institutions like the EU and the IMF. Who bails out the EU? And the problem is there is nowhere else to pass it on to now.
Well, you mentioned the banks, but it was actually industry as a whole in many of the car manufacturing side of things, automakers is what I'm talking about here, when we saw private debt put onto the public balance sheet, and that's what we're dealing with, isn't it?
Exactly, and central banks are beholden to debt. They need to create more to try and sustain the previous debt that's been created. They need to inflate the asset prices that underpin all of that debt.
Okay, so my question is, you've not answered it yet, which is, we may be in towards capitulation. How much longer does it actually last?
It's a very difficult question to answer. I think what will happen is we will start to see a differentiation between various markets. And I think, if you look out here, I think, do you want to be in markets where there are surpluses all over the region, or do you want to be in economies where there's debt as far as the eye can see? And I think, the trade deficits, the current account deficits that we see in Western economies are mirrored over here in terms of surpluses. We have very little debt in Asian economies. Emerging market economies account for about 17% of total global sovereign debt. So what we will start to see is a differentiation. So before we see the capitulation, I think we will start to see certain markets start to outperform.